I have a fixed rate mortgage for my house, and I wouldn't even consider a variable rate loan. Why do so many commercial real estate investing companies use floating rate debt? I'm Jason Kish. I'm in the commercial real estate investing space, and we're going to dive into why floating rate debt is used so commonly in the multifamily commercial real estate space. We'll start off with the least impactful reason, but it's still plausible, and that's that variable rate debt could be chosen because the price can start out a little lower. You could potentially get a slightly lower rate depending on what the market looks like. Floating rate loans are based off of the SOFR or the overnight rate, which is set by the Fed, and fixed rate loans are generally based off of bonds. They're based off of two different markets, so they can move against each other a bit. Here's a simple cost sheet from KeyBank. Keep in mind that this is just a small sliver of their offerings and not really representative of all the choices that there are. I just want to show you how this is broken down at times. You can see that the fixed rate for some of these, as you go through the different terms, the amortization schedule, or the pace that you're paying off the principal on it, it will change what your percentage is that you're paying. The loan to value percentage also changes it, or as measured in DSCR, debt service coverage ratio, that changes it. So when you compare the fixed rate versus the variable rate on this sheet specifically, they're not really very different from each other, and certainly nobody's going to make the decision to go variable rate based on the difference between these prices. Some of the fixed ones are actually slightly better rates than the variable ones. Interesting. Another aspect that could make floating rate debt a good choice that's actually more realistic is the rate could potentially come down as the Federal Reserve cuts rates. I mentioned before the SOFR or the overnight rate. That's the rate that the Federal Reserve cuts. When you hear the Federal Reserve is cutting, they're cutting that overnight rate. So that impacts variable rate mortgages because you usually have the SOFR, that overnight rate, and then you have the spread on top of that. And as the SOFR goes up or down, that spread generally stays the same through the loan, and it can move up or down. So you could bet that it's going to go down. Let's take a look at the rates right now. We're looking at the Federal Reserve Bank of St. Louis, or FRED. We're looking at their 30-day SOFR average. You can see that during 2021, money was literally free from the government. The overnight rate was set to 0, and then they aggressively hiked. This is where anybody that was in a variable rate mortgage, their rates went way up because they had the 0%, and then you had the margin on top of that, where now it went all the way up to over 5.25 at one point. But some people are betting that this rate is going to come down, this overnight rate. You can see every time the Fed cuts, it comes down a little bit more. So that's another reason that people could choose variable rate mortgages. It's honestly not really that viable of a reason either. There's just some potential upside there. Let's talk about the thing that people really use it for when they're putting together a commercial real estate deal. So what if you're going to buy an apartment complex from the 90s? You buy it for $10 million. Your game plan is to renovate it for an additional $2 million. You optimize the operations, and you're looking to sell it in a few years for $15 million. That would give you a $3 million profit, plus you would receive the cash flow while operating it. Unfortunately, this is something that an agency loan, it's just not going to work. And it's because there are a bunch of guidelines that you need to follow for an agency loan to actually work in commercial real estate. And when you put all the guidelines together, not that many projects really fit inside this small box. Let's look at these limitations of fixed agency loans a little bit more in detail. The 90-90 occupancy rule. So you need to have 90% occupancy for at least 90 consecutive days prior to closing. There is a distinct lack of flexibility. So value add projects, a lot of times they require a change in strategy, construction financing. They might have capital expenditures as you go along in the project. And agency loans are really, really strict with the underwriting, and it really just gums up the works. Even if the loan says that you can do those sorts of things, there's just a lot of red tape involved. The stabilization requirement, this is another piece that can be an issue. The agency loans, they want something that's stabilized. Basically that there's already enough cash flow to make them feel confident in this loan. During these value add deals, sometimes the cash flow isn't great up front as you're doing your value add project, and then the debt service coverage, it goes up throughout the project. Agency loans, they're more strict about the debt service coverage ratio up front. Now, this is the one thing that we haven't talked about yet, and it's actually really, really impactful. There's a high prepayment penalty. This is not like a 30-year, 15-year mortgage for your home where you could just prepay it at any point. If you prepay your fixed rate loan, a lot of times you need to pay maybe all of the interest that you were supposed to owe over the length of the loan, or maybe there's a step down and you owe a certain percentage based on the amount of years that you held it. But the bottom line is that you can have really high prepayment penalties. The company that I work for, we had a deal that we exited a few years ago. We doubled money, which is a 2x equity multiple. Well, we would have had a 3x equity multiple, except that we used fixed rate debt. The prepayment penalty ate up that much of the profit. So you might ask yourself, if the project isn't the right fit for fixed rate debt, how do I reduce the risk of rising interest rates? The thing that you can do to help is purchase an interest rate cap. So this is not to be confused with cap rates or capitalization rates. A rate cap is just something that as you have this floating rate debt, the rate cap acts as a ceiling, so it can't go above that. So for instance, you might buy a rate cap at 5.5%, and if the floating rate naturally would have gone up to 6.5%, it's not able to do that. These rate caps, they keep a lid on it, but they're only for the amount of time that you purchase the rate cap for. That's something important to note. So when you're using floating rate debt that a lot of times is more suitable for shorter durations, you need to make sure that you have enough money to maybe buy another rate cap when you have to refinance, or that your project itself will have high enough of a debt service coverage ratio that refinancing will be easy. I hope you found this topic insightful. Please like and subscribe because it helps the channel immensely. Thanks for watching, and I hope to see you on the next one.